The reason we've put APA into the portfolios is, to be quite frank, it's the one across my core infrastructure universe where I just can't believe that coronavirus can actually have an impact on it. Logic there is over 90% of the revenues are either subject to a take-or-pay contract or are regulated. So take-or-pay contracts is where a customer is paying for reservation of capacity within a pipeline. It's not paying for the volume throughput. That's the 90% component. Those contracts are only really as strong as the counterparties that they're actually contracted with, and over 90% of their revenues are coming from counterparties that have got investment-grade credit rating. So think about the AGLs, the Origins, the Energy Australias, the Rios, the BHPs, etc. of the world. That's who they're contracted with. Average contract term on a revenue-weighted basis is over 12 years, so it's not like you've got some sort of cliff face coming on in terms of your revenues. So business that's got EBITDA margins of over 80%, with the strength in the revenues, should mean the balance sheet is resilient through this period. It's got a triple B credit rating, so that's 2 notches into the investment grade sort of credit rating ladder. And on my number crunching, it's actually heading towards triple B plus. Its credit metrics are getting that strong. It's got staggered debt maturities across time, which means it doesn't have like any major refinancing risk. It reported at the end of the first half of 20 that cash and undrawn bank facilities added up to 1.35 billion, and they've got only about less than $400 million of debt due over the next 2 years. So really easy for them to handle that. Distribution, I mean, they're unusual in the sector in that they've got very large coverage of their distribution from their operating cash flow. Their guidance is for distributions of 50 cents this year. And look, I think they can actually grow that by sort of 4 to 5% over coming years. That comes from new assets coming online. It comes from investment in new growth projects. A major part of their earnings comes from US dollar denominated revenues to do with that LNG pipeline going from Wallumbilla up to Gladstone. As Aussie dollar spot rates fall and their hedge program rolls off, the actual benefits of those US dollar revenues improve. And also, they've got a debt portfolio where a lot of the debt is actually way out of market. So as that expires, they will refinance at far lower levels and get a kicker there coming through. So looks like a very solid stock in this market. It's been a long time since I've seen this sort of value in the stock. Let's not forget that Hong Kong had a crack at this thing at $11. It's now trading at $8.36. I've got a target of $10.90 on it, and it's yielding a cash yield of 6%. So to me, it looks like a pretty solid name to put into the portfolios in this sort of environment. With Transurban, look, I suppose there's a couple of things going on there. We have a lot less visibility in terms of their traffic volumes than what we do for, say, Sydney Airport, which is putting out monthly traffic. Transurban only puts it out quarterly. But typically you'd expect Transurban's traffic to be very resilient. But if we start to see stuff like schools being shut, if we start to see people working from home a lot more, then obviously there's going to get a lot less utilisation of their roads. The offset of that, part offset I should say, is that people may stop using public transport and actually drive a bit more. The reality is though, in Australia at least, public transport is a great competitor to their roads. So I should point out the Australian roads I think should be a lot more resilient than the US roads. The US roads are very interesting. They're called express lanes. And the way that works is they're allowed to charge whatever they want to keep the traffic flowing on their roads at 50 miles per hour. So if traffic volumes go down, then they drop the pricing. If traffic volumes are going up, they can actually crank up their charges to whatever they want. So if we start to see the worst case here in the US where volumes are going down, they could actually have the double whammy of volumes down and pricing down. So that could really hurt those roads. Also sitting out there, Ben, is they've still got these Westgate Tunnel project construction issues that they're having to deal with. So, it was holding up for a long time, Transurban, now it's come off. I sort of see that as looking like great value at the moment. If I look at it just against my target, my divvy forecast at the moment, it's like a TSR of 40-odd%, so incredibly strong. Look, I've got the view that traffic volumes are going to bounce back. Once we get through this, we actually return to normal. To me, normal is 2021 looking like what it was in 2019. So that's my base case. But I just want to take you through some number crunching I got here. Let's just scorch earth it, right? Let's just say absolutely no passengers go through the airport for 12 months. What gets hit there is all your aeronautical revenues disappear, and all your car parking revenues disappear. Very debatable about whether the retail leases hold up and also the property leases, but let's say they do for the moment. That knocks about $900 million of EBITDA off the business. That's about a 75% hit to EBITDA. Now, when you actually put that on a per share basis, right, so there's 2.26 billion shares on issue, that's only about 40 cents a share. Now, if you post-tax that, that's actually 29 cents a share. If you say, okay, this business, in that sort of scenario where they would actually suspend the distribution, that means that the 19.5, 20 cents that I thought was going to go out the door actually remains within the company. That offsets that. You actually get down to an impact of only 10 cents a share. Now, you can mix those number crunching around. You might say, okay, well, passengers won't go to zero, therefore their aeronautical and car parking revenues hold up a bit better, but maybe we see a bit of a chop to the retail. But overall, if you sort of run through that number crunching, you can see how resilient it is. Then we get into the question of balance sheet. Okay, so if we are in that sort of scenario, can these guys actually get through it? So first up, they've got $1.4 billion available debt capacity, plus the cash on their balance sheet, which is $400 to $600 million. They've got a debt maturity of $760 million or so in November, so it can easily be handled by that available liquidity. Cash flow, even in that scenario, just manages to service the debt. It will probably breach debt covenants, but the reality is I think the banks would actually look through this. And then you're getting into credit rating. So it's a BBB plus credit rating at the moment. I think it was getting close to A- credit rating, so just very strong and improving. They actually say to me, look, we actually only want a BBB. BBB credit rating gives them competitive pricing, tenor and appetite within the market. So personally, I think the rating agencies will look through this pandemic and sort of sit on a more of a medium-term basis. So to me, when I see where the pricing is at the moment, it looks like it's absolute disaster scenario. It's basically assuming we never get back to any sort of long-term growth coming through on the airport. So to me, it looks like great buying.